What's up, everybody? Today I'm going to talk to you about everything bonds. So a bond is basically a loan from an investor to a borrower like a company or a government. This is how they raise money to use. So think of yourself as the bank and you're giving them money to use and being paid interest for it. So there's several different types. These include government bonds, corporate bonds, municipal bonds, and tons of others. Now these are considered fixed income instruments because the terms are set at the beginning and it pays out according to those terms barring a default. The owners of these bonds are considered debt holders or creditors of the issuer. So the bond details usually include things like an end date or maturity date when the principal of the loan is due to be paid out to the owner. It also includes terms for variable or fixed interest payments made by the borrower and when they're going to be made. Now when it comes to maturity, it can be anywhere from a year to 30 years. Less than a year, it's considered a commercial paper or bill. 1 to 10 years, it's considered a note. And 10 to 30 years is what you think of when you think of a traditional bond. A new issue just means the company raising money through a bond. The face value is the cost to buy a bond, and usually this is set at what's called at par, which is $1,000 per bond. The actual market price of a bond is going to depend on a number of other things. The credit quality of the issuer, the length of time until it expires, the interest rate compared to the general interest rate, all kinds of things. The coupon is the interest from the bond that's usually paid out twice a year. And then obviously the coupon rate is the interest rate that it actually pays out. Now bond prices are inversely correlated with interest rates, so when interest rates go up, bond prices tend to fall and vice versa. And if that happens, you can also sell your bonds to other investors or buy bonds from other individuals way long after the original organization raised the capital. So you don't have to hold a bond all the way through to its maturity date. You can also repurchase a bond if interest rates decline or if the borrower's credit has improved so they can issue bonds at a lower cost. The tricky thing is the backing for bonds is typically the ability of the issuer to generate revenue, but sometimes physical assets can be used as collateral, like when a bank gives out a loan. So as you can imagine, because of that, corporate bonds are usually seen as riskier than government bonds, and they usually have higher interest rates because it's much more likely for a company to go under than an entire government. And like we mentioned earlier, before buying a bond, you really have to look at the other risk factors of that company or a government or whoever it is that's promising you this money back. What is their ability to raise that revenue? How are they going to do it, and how are they going to pay you? You have to look at all that before investing in a bond. Now we have other videos on stocks, but just to touch on it quickly, a stock is a type of investment that represents the ownership of a fraction of a corporation. So you actually own a piece of that company. Whereas in a bond, they just borrow your money, pay it back with interest, and then that relationship is over. Now there's obviously pros and cons to both bonds and stocks, which is why most people generally hold a mix with more bonds as they get older. Bonds are generally considered safer, but they have less of an upside than stocks potentially do. With that said though, they have a lower downside as well because stocks can just crash completely, whereas bonds tend not to do that. So depending on your risk tolerance, age, responsibilities, and goals, you're going to have to assess where you are and assess for yourself where you want to put your money for the best return. As a young guy with no kids, I don't have any bonds. As people age, they may choose to hold like 70% stocks, 30% bonds, and then progressively move towards bonds and less stocks because again, that safety factor. So as always, you're going to have to do your own research and reflect on what your goals are with your money. This isn't financial advice, it's just educational, but I hope that helped you guys out. Be sure to check the description for our newsletter and everything else we have going on, and we'll chat with you next time.